Hey guys, I am Kyler Johnson, excited to be here with you today on my market spotlight ending April 27th of 2024. But before we go any further, why should you listen to me? There are countless gurus across the internet that you can listen to. But on this channel, I wanted to let you guys know I am actually putting my money on the things that I talk about here. Everything that I talk about, I spend my own time learning and trying to understand because it's actually places that I want to put my own money to grow for the future. And not only that, but I also have hundreds and hundreds, probably thousands and thousands of hours of learning and actually looking at fundamentals in companies. And I feel like even though I might look young, I have a lot of experience, especially for my age, looking at these companies. I am not saying that I have made it yet or I am the master of all masters by any means, but I wanted to let you guys know I'm coming from a place of this is where I put my actual money, and I don't want to waste my own time, and I don't want to waste your guys's either. So with that, kind of give you guys a plan of what we're going over today, touching on not only what happened in the actual markets this week and just a little bit of updates as things change. We'll also be touching on some thoughts that I had around the government's mounting debt, what things have done in the past and how we got out of it, and touching on a new company that I'm actually going to be adding to my personal portfolio. So with that, guys, we'll jump right in. This week, I always like to look at the weak performers in the different sectors and how they performed. You can see the number one performer this week was airports and air security. Interestingly enough, semiconductors had a couple spots up there as well. You can see what sectors did well. Those that did not do well, on the other hand, trucking, lumber, steel, insurance, and pharmaceutical retailers. So I like to look at these just because it might be an opportunity to look into these industries that are suffering short-term dislocation. Look for high-quality companies in there, and you might see one that's completely mispriced. As my goal here is to find companies that don't match with their intrinsic value. They have short-term dislocation and capitalize on it. Whether that's for companies that I will hold forever because they are high quality or just mispriced, or for companies that are good quality that I may not hold forever but offer a really interesting opportunity to buy them for pennies on the dollar. Moving to what SPY looked like this week, you can see these 5 days, it was just a really choppy market. We've been used to things kind of having a really specific trend, it feels like, whether that's up or last week down, and got a little bit of chop this week, which was interesting. I wanted to touch on as well the Hang Seng, HSI, which this is just the last 5 days. And you guys can see at a low of 16,640 and closed at 17,651. This was a monster move for this market, and it looks like it's finally coming out of a serious bear market here, which is really exciting. This is one of my biggest plays in my portfolio. Been buying down all the way into the bottom. Actually got an option, awesome enough, literally at the lowest day, at one of the lowest points, which was really cool. Just happened to be lucky. I didn't time anything on purpose there, but just found things were getting more dislocated and I felt like I could take that on. So some interesting moves there. Touching on some different metrics, moving my picture out of the way, touching on some different metrics, the NAAIM exposure index, which I just like to look at a bunch of different things to give a general probability of what markets could be doing. And you guys can see as this active investment manager exposure index fluctuates around, you can see up at its highest point, they're actually leveraged more than 100% long. And at their bottom, you can see what percent they are long, what exposure they have to the index here. And you can see we're kind of at a middle point right here that doesn't necessarily indicate any major moves either way. It certainly doesn't indicate a topping here, and it doesn't indicate a serious bottom either. Another one, the breadth momentum. This one is more indicative of things kind of bouncing off their lows, but a little bit in the middle ground, not really telling us, comes with the chop. Another thing that I wanted to touch on was the 10-year Treasury. And you can see over the last 5 days, it certainly rose some here. As markets change kind of their thoughts on what this year is going to look like for cuts, the markets have pretty much priced out almost all cuts this year. I would expect there probably still to be some as more disinflationary pressures come through. I think that we'll still probably get a cut or two this year, but it will be interesting to see kind of what happens, as rates have certainly risen quite a lot from their 2020 lows, but aren't anything near the previous highs we have, and are actually sitting right around historical averages. Another indicator, the S&P 500 new high and low percent. This one is sitting at a level that I would consider to be a more of a buying opportunity for sure. Not at its lowest point by any means, but again, kind of indicative of the chop here. Now, moving on to the federal debt, the situation that the government's in right now. Currently, we are sitting at a comparable level to the mid-1940s around World War II, and the debt levels here, you can see in 1946 peaked at a debt to GDP ratio of 120%, and currently we are sitting just above that right now, sitting at 120.5%. And the government continues to spend. They certainly like to throw money at problems. And what did they do in the past? As you can see, they were able to bring things down quite well for a long period of time. In the 1970s, had a debt to GDP in the 30s, which feels unheard of compared to where we're at now. And I wanted to look at the CPI and what this actually showed and how they were able to get it to the point that they were. And it might not be great news for the individual consumer, but this is probably the most likely scenario, in my opinion, for how the government actually gets this down. And it's letting inflation run higher than they would like. You can see this actually only goes back to 48, but you can see before this it was high as well. Inflation sitting between 6 to 10%, probably won't run that high. But again, another spike here, a little bit higher than they would like. And then, as we all know, in the 70s, things rose quite rapidly. But this is probably what the government's going to be looking at doing. Whether they actually express it or not, is inflation might run higher than anticipated, which will slowly bring down the debt to GDP ratio, just like it did around World War II. And they're probably never going to the Fed's never going to change their view on working towards a 2% rate. And that's because they need to anchor inflation expectations. If those expectations become unanchored and really start to rise, then we could see a serious wave of inflation come through, as people feel they need to actually get rid of their money now and spend now versus wait, because they're expecting prices to continue to rise rapidly, and that, is a self-fulfilling prophecy. So an interesting situation here, but this is probably my view of what's going to happen. Certainly, I don't think a debt is a non-issue, but this is not a new scenario for the country. They have gone through this before, and whether we feel like it or not, currently the U.S. is pretty much supplying two wars across the world right now. World War II, drove this up. Different scenario, but I think that we will probably have a similar way of getting out of things here. So from here, a couple things that I wanted to touch on. First off, Boeing announced earnings earlier this week, and their earnings were about as I expected. Not pretty, being drugged down by lower deliveries as they implemented more training, higher quality controls, and just really shifting things around to avoid all the problems that they've had come up recently. But their new orders were still crazy strong because companies have nowhere else to go. They have nowhere else to go. There's Airbus, but they are going to be waiting far longer to get their planes, and Those are the two options. When you have a company that operates in a duopoly like this, they can continue to make mistakes over and over again. And I actually heard on the Thomas Hayes Hedge Fund Tips podcast, he said it was being run by a ham sandwich. And that's why Warren Buffett likes to find companies like this that can be run by a ham sandwich and still be a good opportunity, because someday they will be. So interesting quote there. I always love listening to Tom on that channel. I'll link it down below. Also said they will get things turned around and get back to generating cash here. I have no doubt that they will do that. They received 131 new orders in Q1, which is far more than they actually delivered. And they have a commercial order backlog sitting at almost 5,600 planes, which are worth approximately $450 billion. Guys, this company isn't going anywhere anytime soon. Even though things look absolutely dismal right now, it's a company that is absolutely necessary. There's nowhere else for these companies to turn. And if they decide to start going to Airbus, things are going to get pushed out so far that companies are going to be waiting a decade or more for their plane. And by that time, Boeing's going to get things figured out. They have a new CEO coming in at the end of 2024, and they're going to be able to turn things around. I have no doubt about it, and it's why it's one of the plays that I really like. It might not have the same upside potential as some others, but as far as conviction, it's a very high conviction opportunity for me, and I wanted to share it with you guys. Next thing, Opportune. If you guys have followed this stock at all, it's one that I would say is in a more of a cigar butt situation. But if they're able to turn things around, it has a interesting business opportunity operating in a niche section of the banking and finance, where they facilitate higher interest loans to people with poorer credit, kind of taking away from loan sharks. And that's kind of where they sit. But they have been run absolutely terribly, to put it mildly, and their stock has been crushed as a result. But they recently appointed some new board of directors, and the stock popped that day. I think it was 40+%. I don't actually remember. Just because people are seeing, hey, they're at least taking steps towards getting things fixed here. By no means am I saying this is now amazing. They have an absolute crap ton more work to do. The only reason I'm even still here is because I have a crazy low cost basis sitting around $2.15. And so I'm willing to stick it out. It's a very small position for me. Certainly got more risk to it. But if they're able to turn things around, it could be a very interesting play. From here, let's go to a stock that I recently found because it absolutely was crushed on their earnings for no apparent reason. Mr. Market was irrational, as it usually is, and presenting an opportunity, in my opinion, to capitalize on a extremely high quality company that compounds capital at fantastic rates, is growing like crazy, and in an industry that is pretty boring, which I actually like a lot more, and that is insurance. And that company that we're looking at here in insurance is Kinsale Capital Group, ticker symbol KNSL. This was a really interesting find, and I found this, as you guys can see, just the other day. This is just their past week on the 25th. The 26th, dropping about 17%, if I remember correctly, on Friday, and just getting crushed. But they actually beat on pretty much every metric you can imagine, whether you're talking about revenue, earnings per share, free cash flow, any measure that you can imagine, they actually beat on. But I think this is the cyclicality of the insurance industry, which I'm going to talk a little bit more about here shortly. This is a property and casualty excess and surplus insurance company. Excess and surplus, also known as an E&S insurance, is designed for businesses with uniquely high risks and the traditional insurance market will not cover. The types of businesses that may need excess and surplus lines are in industries like construction, building, roofing, commercial transportation, just companies that are in special situations that might fall out of the expertise of regular insurance companies. But that means this company, because they have a really good operating structure, can charge more for their expertise, and these are traditionally higher risk industries, so they're able to charge more for their as well. And you can see their full stock chart. This company has been nothing but up and up and up. This dip right here, you can see falling from the mid 500s to 375. Looks like it's 378 after hours. And in the past, month, they're down almost 30%. But this is a crazy high quality company. You can see trading currently at a price to free cash flow of 10, but we're going to talk about more why that's probably appropriate for most insurance companies, but I think for this one, puts it in a more attractive place than most. The current issues that I believe why it's been pushed down is profits and revenue are at all-time highs, and when things are all-time high, things start to look a little bit worse for the future because insurance is such a cyclical industry. As things really rise, then there's a period of things being higher margin, just less accidents, less insurance claims for the companies to cover. And at that point, they know coming around the corner, things probably aren't going to look as rosy as they are. And I think it's actually laid out. We'll see if I can pull this up below. You can see their net margin in 2021 was a peak right there. But if you look at their stock price in 2021 was actually a trough. And that's because they were looking to the future and thinking, hey, things aren't looking as good as they have been. So from here, looking to the future, saying things aren't looking as good. And I think that's actually exactly what's going on right now. You can see we're kind of at another peak here, and they're maybe looking forward to a future like this where the net margin isn't quite as good. And I think that could be one of the reasons why we're seeing the company fall. Take a dive here. Although even on the stock chart, it's really not that big of a fall, but I thought this, because of how high quality it was an opportunity to buy one that could be an excellent long-term compounder at a slight discount or even just at fair value. One of the other thing that I wanted to address was their market share. And this is as of 2022, the leading US excess and surplus insurers. You can see number one is Berkshire Hathaway, and going all the way down the list, Kinsale Insurance is actually just sitting at 26 here. In 2021, having a 1.2% market share, growing to 1.5, which was a 44% change in their insurance premiums collected. So they jumped here, they jumped again in 2023. But I wanted to share this with you guys because this is still a pretty tiny company when it's compared with the market size. And as you're going to see here later, they are still growing very quickly for this little company. And you can see there are very few other companies that even rival what they were growing at. So I thought this was important to touch on. Also, in the industry, there has been continuous, from what I can tell, good news about the surplus lines of premium, excess and surplus, and several different places have revised this to a positive outlook. This article says continued growth for surplus lines in 2023 as premiums are up 14.6%. Here, AM Best is revising its outlook on the excess and surplus lines insurance segment to positive from stable, citing increased business due to declining capacity in commercial lines and some personal lines markets. Basically, other insurance companies are pushing these situations off of their books, and it's going to continue going to these specialty insurance companies. And also, along with strong underwriting results driving favorable operating profitability and strengthened capital positions. Some really good news. wanted to touch on combined ratio that we're going to talk about here. The combined ratio is the incurred losses plus expenses divided by net written premium, basically saying what percent of the written premium is coming back as expensed out and what percent is going to profits. So here is a few different metrics for the different parts of excess and surplus insurance market. And you can see their combined ratios as a market average. You can see overall sitting in the 90s, mid 90s in 2015, going to 98 to over 100%. This means claims were eating up more than was being collected in premium. And then falling back down until 2022, actually going just over 100% again. And the different lines, whether you're talking about property, casualty, industry, another industry here as well. So overall, sitting at right around paying out in claims just as much as they're collecting. Very, very thin margins there. But I wanted to show you guys what Kinsale Capital's combined ratios looked like. And I pulled this from each of their annual reports from these years. In 2016, they sat at a combined ratio of 74.3%, more than 20% better than the industry average. 2017, it did rise to 84%, but it's still right around 20% better. 2018 rose again to 85.3, 2019, 84. You guys can see here in 2023 posting another fantastic year with a combined ratio of 72.1%. That is almost 30% better, or sorry, I'm looking at 2023 compared to 2022. 2022 was 78%, which was about 25% better than the market average, meaning this company is running in a position where they are paying out less in claims and their expense ratio, their expense cost, whether that's for sales, marketing, all that kind of stuff, is lower than most. They run more efficiently by a mile. This was crazy to be able to look at. And on top of that, let's look at some of their metrics. Their total revenue growth since 2013, you can see, has been a absolute monster. This 2013 doesn't even really register on the chart of how much they were growing. You can see even in these down years, this line right here is the percent change year over year. These down years right here, like this 2015, they still probably grew about 30%. Their revenue grew about 30% in a down year. In 2018, this was probably quite a bit lower, around 15%, but in a down year, 15%. And even just in 2023, their revenue grew 43%. This company is on an absolute tear, and they talk a lot about how they're able to do so in their annual report. Just having technology and able to provide quick and better service. We'll see how this plays out over the long run, but at least for right now, it seems pretty clear to me that they have a moat because of their cost structure, having lower combined ratios, as well as still being able to attract a lot of business and gain market share. Their net margin as well, I showed you this before, overall has been really, really good. Here sitting probably in the high to mid 20s at their peaks, and even at their troughs, maybe high teens, low 20s for a margin. This is fantastic for an insurance company. And we'll see kind of where it goes from here, probably looking at a peak, coming down to a trough. Just as like I said, this is a very cyclical industry. So we'll see kind of how things go there. But this was one of the big kickers, their return on equity. And this is Warren Buffett's favorite financial metric here, and this company absolutely knocks it out of the park. When you I compared it to other insurance companies, and the return on equity is pretty much at the top. They sit as one of the highest quality excess and surplus companies as far as the management's ability to generate returns compared to their equity here. They are compounding capital like nobody's business. It was awesome to see. They've got this combination of fantastic cost structure, fantastic growth going forward. their management knows how to compound capital, and they just fell almost 20% in a single day. They're sitting at a 10 times price to free cash flow ratio. This is one of the best companies that I've seen in a long time that has been absolutely crushed on their earnings. And another high quality one, obviously Meta, got crushed, but maybe not near not even close to a 10 times price to free cash flow ratio. So overall, this is just a phenomenal company. It's growing very quickly, has great returns on equity, and a growing market share, which is one of the reasons why I will be adding it to my portfolio. I think it's a pretty, maybe in the medium basket as far as conviction goes for me, and maybe kind of in the mid-range of returns when compared to my other investments that I currently have that are looking like multi-baggers. This one is probably a hold forever unless the fundamentals of the company change. They lose their moat, their management isn't able to return the same equity, their growth turns negative, or their margins collapse. We'll be paying attention to all of that, but for now, this is a company that looks to be poised to grow very, very well going into the future. And the insurance industry itself, specifically the excess and surplus, is growing fantastic as well. And so when you've got a tailwind on a company like this, that the premiums alone are going up 15%, and different insurance companies are kicking these types of situations off of their books, this company is poised to do very well. And this is a fun one. I'm excited to add this one, and I'm always looking to have between 10 to 12 companies in my portfolio. I don't want to do any more than that, as then you're going to inch closer and closer to probably a market average, and I am not looking to do average. I am looking to generate excess returns from the market, and so far this year, I am doing so. Maybe not quite at the clip that I would like, but you can always do better, and I'm learning along the way, sharing with you guys as I go. So hopefully you found this valuable. Remember, as always, this is my opinion. Consult with your financial advisor on this. I don't know your financial position, but with that, guys, we will see you in the next one. Thank you.